everyone, and welcome back to another FM Talks. Joining us today is Dr. Renée Friedman, Global Head of Research at EXANTE. Hello, Renée. How are you today?
Hello, I'm well, thank you. How are you?
I'm very well, thank you. Very exciting conversation we have going on today. Um, So I was interested to know, what does a global head of research actually do, especially in such a big company?
My role within the company is really to help produce, or my team produce our content, which is our daily, weekly, monthly, quarterly market analysis. We also produce an equity monthly review, a fixed income monthly review. We produce a weekly crypto, currency, and general news update that we send out to our clients, and white papers, higher levels of research, of course, research papers that go out. We also, as part of my role, is we conduct various webinars, much like this, but with other people. And we do hold our flagship Horizon event. So I help in the organization of that, where we speak with external speakers, people from different aspects, different backgrounds, discuss the markets in different locations. So we're able to give a global view of what's happening, as well as take a look and break that down into what's happening in specific regions and what's moving things in those regions. So
I
that's
see.
roughly what my role encompasses.
That's a lot. And with all the things that you research, how do you decide what to focus on a daily basis?
Well, essentially, we look what's happening in the markets. So this is, obviously part of my, very important part of my job is just really monitoring the news flow of what's coming through. Not just the data points, but what's really pushing behind that. So taking a look at the geopolitical maneuvers that are happening, taking a look at the wider issues that are happening in society and how this is being reflected through fiscal policies by governments, through the impact on monetary policies, and of course, how all this impacts equity markets, said bond markets, and other asset classes.
That's great. Um, Speaking of daily news and what's been happening, um, tariffs have been in the spotlight ever since the Trump era. What's sort of your take on how they've affected global trade and investment sentiment?
I think at the moment there's a lot of confusion about tariffs. Of course, we've had since President Trump's Liberation Day on 2nd of April, where he announced a whole slew of tariffs. Now, this had been discussed beforehand when he was running, and then it was actually implemented in April. And a lot of market participants were very uncertain as what actually happened. And then we saw a bit of a pullback on that for negotiation, because of course Trump is all about the deal. So I think where we currently stand with tariffs, we've seen various negotiations. We've had negotiation with China down from 145% tariffs all the way down quite significantly to I think it's 30%, roughly on some things, a bit higher on others. And of course, Trump has maintained the steel and aluminium tariffs of 50%, regardless of whoever he's negotiating with. We saw a deal this week with Japan for 15% tariffs, and we're looking at, on top of existing tariffs, about 2.5%. And we're also looking at the moment, negotiations with the European Union seem to be proceeding. And of course, many other nations coming through have been in negotiations, including Indonesia, which recently signed an agreement or is in the process of signing an agreement. Vietnam, other countries are coming through on agreements. I think what it has done to the market, it's been quite unsettling in many ways for a variety of reasons. And this is simply because tariffs, of course, are by their nature inflationary. They do have a cost to the end consumer. And of course, that end consumer will be, in the US case, the US consumer. But if we get to the point of retaliatory tariffs, which the EU, if it doesn't reach this agreement, has threatened approximately 93 million worth of retaliatory measures. It does mean that it will impact growth potentially within the EU, which is only slowly recovering from a downward growth path. And a lot of that has to do with increased fiscal spending coming out of the EU expected over the next few years, particularly related to defense areas. So what this essentially means is that the tariffs are risking higher inflation for both the US and the global economy. It's risking slower growth. It is contributing to weakness within the dollar. And it is causing a lot of concern politically because there's some degree of backtracking, there's some degree of bullying, so it's a lot of uncertainty that it's creating. And that in turn does make investors very nervous. In terms of, particularly when it comes to capital investments, which you asked about, is where do I invest? How much should I invest? Because we know, for example, inflation may be going up, or we saw in the recent CPI figures coming out of the US, we are starting to see some degree of tariff pass through. Still very small at the moment, but it may be building over time. And it's not clear if this is going to be just a one-off or a continuing issue. That has put the Fed, or kept the Fed, I should say, on hold. It hasn't cut rates at all this year. Although, of course, we've seen cuts in other countries throughout Europe. And of course, the ECB itself has been cutting rates, although it kept rates on hold for the first time today in quite a while, because it is at its target rate of 2% inflation. And even they are still being cautious about what may or may not happen with tariffs and potential inflationary effect. And as I said, the weakening of the economy. So it has kept investors very, very cautious about, particularly if you're thinking in terms of direct investments, whether it be through FDI, of waiting to see what happens a little bit on that. The cost of capital, at least in the US, has not come down dramatically. It's still quite high. In Europe, it has been coming down with these ECB cuts. And of course, Japan will be raising its rates, for example, over time. So it's also, as I said, I mentioned the weakness of the dollar and how it's affecting bond markets a bit. We've seen steepening of yield curves, global yield curves, because of course, if the US yield curve goes up, and there are other reasons why the US yield curve has been going up, particularly related to debts and deficits, it means that the rest of the world will have a very difficult time in keeping their rates lower. And in fact, we're seeing this across bond markets in terms of emerging market bonds almost being at the same level of developed market bonds. Equity markets, I mean, in the US are doing exceptionally well, though, despite all of this at the moment, although we have seen some of the statements coming out from some of the corporates reporting their earnings, that there are some concerns about the potential impact of tariffs moving forward.
Great. There's a lot of things going on. Do you have any advice for finance professionals on how they're supposed to move with all these policy shifts?
I think the big thing for investors to think about is obviously they need to keep abreast of the news, and it's very difficult. It's constantly changing. We never know, in many ways, what President Trump will say next. But I think at the end of the day, it's about diversification of their portfolios. And we have seen this increasing diversification starting to take place. We've seen a movement out of US equities, more into European equities. People are taking a look at valuations. There have been some questions about valuations in the States. Are they a bit too stretched? Particularly, obviously, we look at the Magnificent Seven stocks, and we've seen a significant collapse in some of those stocks in terms of the valuations, such as Tesla. While NVIDIA, of course, has reached a $4 trillion level, $4 trillion level, I should say. But I would say for many investors, it's the point of diversification. that is the most critical thing that they can do. Take a look at expanding not just where they invest, but how they invest in terms of asset classes. So it's not just a full concentration in equities or a full concentration in bonds, and which types of bonds they want to be at, and the duration. And of course, when you're very uncertain about what's going to be happening with inflation, people tend to move, it affects bond yields and bond prices. So therefore, people really need to consider their views on, do they think the Fed is going to cut? We do see there are projections for 2 more cuts coming through, latest from the Fed, although they're probably, markets are pricing in a little less than 2 this year. ECB is relatively where it wants to be. But yeah, I would say for investors, really think about the asset classes beyond the traditional asset classes, perhaps even. We've seen a lot of investment into certain other asset classes, such as crypto ETFs. We've seen, and that has to do with regulatory change, as well as a much more benign macro environment. Take a look at, I said, locations, so not just the US, into Europe, and potentially into emerging markets that they're looking for yield, particularly in the bond markets, for example. So yeah, it's really for investors, it's don't go with your old formulas necessarily. Diversification is key.
What are your thoughts on the dollar and what's been happening with other currencies?
I think that, well, what's very clear is that the dollar has been weakening throughout this year. It's down over 10% year to date. And it's had the worst start to the year since 1973. A lot of this dollar weakening is again attributable to what's been happening in terms of the tariff uncertainty, what's been happening in terms of fiscal uncertainty, the rising deficit. So people have gotten quite nervous about this. It's actually boosted the euro quite substantially. So the euro has been the beneficiary of this, which is great for potentially for European companies. However, it is not necessarily great for European growth. And it doesn't mean that the dollar is down and out, but it does mean that the dollar is, it will still remain the world's reserve currency, simply because most things are priced in dollars. There's no alternative rival to the dollar. But we would expect to see, and I think globally the expectation is some degree of weakening continue, because we are looking at this political uncertainty that is wrapped up in this tariff uncertainty, and also wrapped up in the uncertainty that we're seeing, or some rising concerns that we're seeing around Fed independence, as President Trump has last week threatened to fire Chair Jerome Powell, although he then has backed off from that. But that, the idea is that markets get worried when we don't know that there's a full guarantee of an independent central bank. So that also has created a little bit of uncertainty in the market. But overall, the dollar, although it has been falling throughout this year, part of it may be oversold conditions, etc. It's not going away in terms of its dominance. So whether or not that will lead to other currencies continuing to strengthen, we've had, for example, a strong zloty throughout the past year. The euro has been strengthening. The pound was performing well, but the British pound has its own issues due to the political uncertainty in this country related to the deficit in this country and the slowdown in the UK economy. But yes, so the dollar has been down, but it is not completely out.
Great. That's very insightful. Thank you. You did mention earlier about debts and deficits. What's going on there exactly, and why does it matter to investors?
Okay, the debt and deficit issue has really come to the fore simply because we have basically governments around the world having to deal with this a lot more. For example, in the US, most recently, we had the passage of Trump's one big beautiful bill, as he referred to this. But the issue with this and why it was so contentious is the fact that it is going to increase the level of the US deficit. It will continue to run at about 6% or so, 6-7% of GDP, which basically means that the Treasury is going to need to issue more debt, right? And the US government already is about 36 trillion or so in debt, in total debt outstanding. And that's growing every month by about $1 trillion, every 6 months, I'm sorry. And the big issue is the interest expense on that debt. So that means that they have to find ways to finance those interest payments. And that can put, it's increasingly, and this is according to the Congressional Budget Office, these net interest payments are set to make up nearly a quarter of all federal outlays by 2054 from the 18% currently. And total debt loads are expected to rise due to this bill to about 160% of GDP. Now that's the very highest figure. It may not rise as much as that. Now the reason why this is so important is where's the money going to come from to pay for that? When you're looking at economies or countries, I should say, and regions as well, because this is an issue as well within the UK. We saw earlier this week the cost of debt payments have gone up quite substantially, which has increased in the level of that deficit spending, which means that, again, the debt management office here will need to issue more debt. The same thing in Europe. Debt levels vary very much by country. Some countries do have much lower levels of debt, but we are looking at increased fiscal expenditures, partially as we look at an aging society, as well as in the case of Germany, which can afford the debt because it's a very low debt level, for increased capital investment in infrastructure and in defense. And what this all means at the end of the day is that rates have to remain higher. If you're issuing more debt, there are less people necessarily buying this debt, or there has to be a greater incentive for them to buy the debt, so rates are going to remain higher. And as rates remain higher, it becomes more expensive. You asked at the beginning of the conversation about capital investment, so that becomes higher. It brings up that point of making life in general much more expensive and can potentially limit growth. So that's why these types of things are really quite important.
Yeah,
Overall.
I'd say we mentioned a lot of things this far. There's a lot of noise, a lot of information everywhere, geopolitics, economics, and markets. How can traders and investors cut through the noise and stay focused on what really matters?
I think one of the things I always recommend to people is, people get shocked by a headline number and the markets always overreact. It never fails. The point is to really focus on the trends. Don't just take a one-time number of something and say, I'm going to make my investment decision off of that. You really have to look at what is driving a particular point, whether it be, if it's debt and debt issuance, whether it is demographic change, whether it is, or increased military spending, for example. If you're looking at how a particular sector is performing, was this due to a one-off regulatory change? Is this due to something wider that is happening in the economy? So my advice to investors to try to cut through that headline noise, which can be quite confusing because it can cause a lot of volatility in the market, very short-term volatility, which can be quite expensive for investors. But to really take a look at what is driving those underlying trends and to try to focus on those most importantly, and look at the regulatory changes, the demographic changes, the trade changes and geopolitical alignments that may be taking place and reflected in changes in trading relationships. For example, we've seen over the past few years, China becoming less dependent on the US export market and more dependent on its trading relationship within the wider Asian region. So yes, although things are, some headlines are, of course, very important to really focus on those trends, to shift through that headline noise, which can almost blindside people.
Definitely. There's a lot of news coming out constantly. So you suggest a little bit more in-depth research.
Yeah, a bit of in-depth research. I mean, there are lots of sources of that. I'd like to say, of course, we produce those through subscribing to our dailies. We give the market update and some analysis on that, and our other content products that we produce. But really, it is not letting themselves be swayed by a quick headline. It's really looking very closely, again, if they're focused in particular sectors, whether it's technology. We have, and a lot of people are very focused on tech stocks, of course, because they've grown quite substantially over the past few years. We've seen this boom in AI, which is not going away, and in fact, will probably continue to grow much, much further because it will be related to other types of investment in other sectors, whether it's banking or defense or healthcare. To really try to think about a sector more holistically. That's what I said about talking about trends, not just focusing on that headline number coming through.
Right. This was a very, very insightful conversation. Where can people go to follow your work or get more of EXANTE?
They can go to the EXANTE website, exante.eu, and they can subscribe to our mix of newsletters there.
Great. Great, great. Thank you, Renée. This was a great talking with you, and I hope we can do this again sometime.
Hope so too. Thank you for having me.
Thank you.